Hi, thanks for joining us today in this speaker preview for the Carbon Solutions Forum. My name is Will Bernholz, and today I'm speaking with Elias Hinckley, a partner at Baker Botts focused on energy and climate finance. Hi there, Elias.
Hi, Will. Thanks for having me.
So, Elias, you've advised governments, energy companies, private equity, venture capital. You've really helped structure the most complex energy projects that make it to market. So let's start broad. How would you characterize the mood right now? What's the vibe in low carbon power, finance, and investment?
I think the phrase I would use is cautiously optimistic. Um, I think that people are looking at some macro trends that are generally positive, some moderation in inflation, maybe some relief on the interest rate side, and that obviously helps infrastructure investment. Obviously, there has been, in the US particularly, some friction on the policy side around sort of the value additive side of low carbon energy. But you also have big demand drivers, right? Digital infrastructure growth is pushing a huge amount of interest in new power generation. Right now, it's how fast can you get to market, but a lot of it's done through a lens of how do I do it on a low carbon basis longer term. So I think as we look at the space broadly, that sort of there is optimism, but it's not untethered optimism like it might have been 2.5 years ago.
So a little bit back to reality, back to the fundamentals.
Yeah.
I think that's a great perspective. So when you're advising your clients, what has become financeable in low carbon power versus what is still struggling?
Um, well, and your phrase, which was sort of back to reality, I think rings true, which is if we think back historically to what has been financeable, it's there's some fundamental pieces, right? It's long-term certainty around revenue, it's technological certainty, and so we see people with first of their kind technology struggling in spots to find financing. Somebody that can't lock in long-term revenue in it's going to be challenged to find financing. So pure merchant play is still a little challenging. Anything that's tied to less certain long-term offtake, right? Sort of uncertain off-taker, questionable credit quality. Those are things that are going to make it harder to get projects financed. The other one that I would point out is, right, there's a difference between what is seen as more durable policy, right? So if I'm building carbon capture, I can point to those 12 years of 45Q revenue and feel pretty good about that. Whereas if I'm working off of a voluntary carbon market revenue, that's going to provide a little less certainty in terms of where my investment is going to come from.
If you read the news, if you follow the industry, data centers are reshaping the entire scope of demand for firm, reliable power. Where are you seeing the most credible opportunities today? Is it wires, pipes, the supporting infrastructure?
Yeah, and so from a wires and pipe standpoint, it's both. Um, and I would say that, and I'm taking wires and pipes as power and thermal side of generation as opposed to sort of the pure pipes and wires, right? Because the long spatial energy assets are still challenging. And so some of this is what can be built on site or relatively close where I've got clear line of sight to certainty of power. And so what you're looking for there are a couple of things. One is certainty, right? Everybody needs reliability, 24/7 reliability for digital infrastructure is kind of critical. Um, there are some shifts and people starting to look at more load following digital infrastructure, but I think primarily people want certainty. And so there are lots of opportunities for power generation. Um, and that power generation is coming from, and this is really an all of the above sort of approach right now is what can I get in the ground in a timeline that allows me to build that data center and get it up and running the way I need it to run in the timeline I want, which is those are shorter timelines than what typically takes to build power generation. Uh, and certainly if you're thinking about sort of a new gas-based power generation solution on site, that can take a little longer than it takes, for example, to get solar and batteries in the ground. So we're seeing some hybrid approaches where people are layering how they're coming to market with that. Um, but I think in terms of the where, um, follow where the development of that new that those new data centers, that digital infrastructure is, and that's where the investment is going to go.
One thing you mentioned that I want to just take a little sidebar on is the idea of generation takes a long time to build. One of the big questions that I think facing the energy industry today is the from the grid versus behind the meter um, opportunities for data centers. What are you hearing and seeing? Is there an obvious preference for one way versus the other? Does it depend on which hyperscaler and data center you're talking to?
So there are a number of factors that go into it. It is the underlying hyperscaler and what their preference is. Some of it's market driven. How easy is it to move power through the wires in the existing system to make sure you have that certainty. Obviously, the price impact is becoming an increasing point of focus. We see pockets where local governments, state governments are pushing back and trying to be sure that you're not going to see power prices rise in material ways because that obviously has a direct impact on voters and other choices. Um, and so it's it is very much a market specific set of choices around sort of what the focus is. It's also practical things. Do you have grid infrastructure that makes it easy to get that power in and out? If you don't, then something that looks like a adjacent or even behind the meter like solution looks a little more appealing than I'm going to work off of an existing power infrastructure and I can just build wherever and move it through the wires because there are wires constraints. And so, right, what I can do in PJM versus what I can do in ERCOT are a little bit different.
So I want to go back to a word you used earlier, which was certainty. And you're moderating a panel at the Carbon Solutions Forum on revenue certainty, investment certainty. Where is there high levels of comfort, medium levels of comfort, or high levels of skepticism right now amongst investors?
Sure. Long term committed offtake with a quality credit counterparty is your gold standard, right? If I can have enough revenue from that long term contract with a really solid counterparty that's going to cover the financing of my asset, right? It gives me the necessary coverage so that I can borrow funds and I can make sure any preferred layers of investment are returned. That works. I mean that's just buildable. And so the question is, do you have the setting, the infrastructure? Can you get the interconnect? Can you get the components to build that asset? If you can, that project's going to work. 45Q, similarly, we know what that is, right? It's a 12-year run of credits. It's a material value. I've got a few other things I've got to pin down, like where is my storage going to be? Do I have concerns about um, there being a dip in the amount of output of carbon that can reduce the amount of carbon credits? But there, if I can lock in those certainties, I know I've got the revenue because my counterparty is the federal government, and so those are good places. Where things get harder is where you start to work the merchant side of things. And so the assumption that power prices will continue to rise, you build into rising prices. I think most people have a view that power prices will continue to rise, and that's a relatively safe bet, and I'm willing to write a check as an investor or underwrite as a lender are fundamentally different than I feel good about your view on power markets.
You've been doing this a long time, so I one day would love to get your historical perspective going back, 10, 20 years. But if you just look at last year to this year, if you're having a meeting with a longtime client last year and then meeting with them again this year, what's something that would be different? What looks different in 2026?
Um, I think probably the biggest thing between 25 and 26 is I feel like people are getting a little bit more comfortable. I think there's a little bit less uncertainty, policy related uncertainty, market related uncertainty. There's still a lot, but I think there's a little bit less. And I also think people are getting a little bit more comfortable that if this is the environment we're going to operate in, I have to be able to figure out how to navigate that uncertainty. And so there's just a little bit of a growing confidence that I've got a little better handle on sort of what's driving uncertainty and maybe a little better handle on how I can manage that uncertainty. That to me is the biggest difference from last year to this year. Last year, it was just, there was so much so fast in terms of uncertainty, especially on the policy front, that I think a lot of people were just sort of, it was sort of constantly off balance, and it made it difficult to really sort of push some of these decisions through. But we've had a year of that, and so there's a little bit more urgency, right? I now need to get things built, and I know it. And there's a little bit more time where I've had a chance to sort of digest some of that uncertainty. And I think on balance, we'll see a much more active 26 than we did 25 for that reason.
Oh, that's great. That's great to hear. And I think we need it, And so, permitting and construction risk are top of mind from a legal and deal structuring standpoint. What protections are becoming standard before FID to keep projects bankable?
So I think having certainty around your interconnection and knowing that that can get built, sort of however that works, even if you're behind the meter and you need some sort of backup reliability like line. I think that's a key piece. I think performance guarantees, somebody willing to wrap the whole project, whether it's the EPC or an insurance product that sits on top, is important. Obviously, known technology is easier than new technology. New technology and technology risk remains a challenge, especially for large scale infrastructure investment. We're seeing new technology come to market. I mean, and this may be just anecdotal, but we've worked on a couple of financings in the nuclear space recently, and we've got others that are in the works. And some of that is new technology driven. So we'll see how that sort of finds its way to market. Certainly, some of the carbon capture technology it's no longer in that sort of N1 first of its kind phase, but it's still relatively early, and we see new evolutions on technology. And so how you get comfortable that you manage that technology risk in a way that's going to let investors and lenders get comfortable that they don't have risk around the operational side is key. And so how you sort of build that sort of protection around the project is key.
Great. Last question for today. So you are moderating a panel. What are you personally most interested in stress testing during this panel? What do you want to hear? And especially, where do you think it's a group of investors and industry leaders, where do you think they might disagree?
Um, yeah, these are going to be fun questions to ask because there is still a lot in play, right? As we think about all of the uncertainty on the policy side, whether it's tariffs or follow-up changes to some of the tax credit structures that support these projects, some of the uncertainty that exists in the tax credit structures because of changes in non-direct things like undermining EPA's greenhouse gas reporting initiative, right? So now I've got to think about how do I measure my relative carbon reduction is harder. Understanding how people are thinking about that, I think, is an interesting topic that we'll spend some time on. One that we haven't touched on here, but I think there's a macro theme around. So, in a traditional investment world, LPs invest in general partners to actually drive the investments, and then when those investments hit a maturity date, they're sold and the funds are returned back up to the LPs, the big pension fund like folks. And that cycle is slowed way down. And so it's
Mm.
causing some capital constraints for who would typically be driving the actual financing of the infrastructure investment. And it's clear there's still a lot of money out there and it needs to find a home. The question is, does it need to start to take different are there different avenues for that capital to come into market? And how will that look in this marketplace? I think is an interesting part of the conversation as well. And obviously, we go back to some of these big overlying macro uncertainties, right? There's the sort of fundamental economic questions. There's the policy side questions, not just the tax credit and subsidy piece, but thinking about tariffs and what the implications there are, which we might get some insight on here. We should have insight on that before the panel. So it may be more of a reaction than what do you think it's going to mean. But I think those are kind of the big pieces that I think are interesting. And then I think the technology side is fascinating too. Sort of right? This is how do we fill in the demand gap and what fills it in, and how do you get comfortable with some of these new technologies coming online faster than they typically would? I think is another interesting topic that we'll explore some.
Well, I look forward to seeing you in San Diego and look forward to sitting in on your panel and watching you press the investors and seeing where we're able to learn something. So, Elias, thank you so much for joining us. Really appreciate it.
No, this is great. Enjoy the conversation. Thank you.